battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to another episode of the Nick Stenger Show. My name's Nick Stenger. This is episode 194. We're the Stenger Family Office for the past 44 years. It's been our family's mission to deliver both clarity and confidence to help secure your financial future. Here we go, episode 194. Will Trump fire Powell before his term is up next year? We'll see. We're going to find out pretty soon. It's interesting to track Powell's performance. He's been in there since 2018. Remember, he got appointed by Obama and then promoted by President Trump this last time Trump was in office, and he's just been there ever since. So has he overstayed his welcome? Has he done pretty well? Some people would judge Powell's performance based on a good landing here and stability in prices, and also maybe unemployment. Unemployment, he's done actually okay, and stable prices, I would give him an F-. Terrible, up 44%, the inflation rate, the past 5 years since COVID started and ended. But other than that, have we had a good landing here? I would say we went into recession in 2022. Nobody talked about it. We had a small dip down in real GDP this year, actually. We'll see if it turns into a recession later on. It's possible. I think if it is an actual recession, you're going to have to see unemployment tick way up. You're just not seeing that. So I think in some aspects, yeah, you could say Powell did well. But I think the economy, this is my opinion, I think the economy's actually done well despite what Powell has and has not done, which speaks to the magnitude and the power of the S&P 500 companies that are the biggest and best in the world in the top 50, which are the highest quality and have managed through this crisis better than anybody else. So I say, Mr. Powell, Trump could probably fire you for cause, but at the same time, we've actually been okay here. We haven't completely fallen apart. Should Trump fire Powell? I don't think so. I actually don't. I think he should just stay the course. Powell's going to be gone next year anyways. But I do think we are about 0.5% over where we should be on interest rates, and I think that's what Powell's going to deliver. Remember, the Fed chair has the biggest ego out of anybody in the country, and they are arguably more powerful than the president in some cases. And all the famous banking families knew this in the 1800s. They said, I don't care who makes the country's laws, just give me control over the monetary supply of a country, and that's all that matters. So arguably speaking, Powell he's got a massive ego. All the Fed chairs ever have. And it used to be that the Fed chairs would quietly make their decisions. You'd read about what they did or didn't do a couple quarters later in the newspaper. Well, now it's like a Super Bowl. Every time Powell talks, everybody tunes in. Everybody wants to know what's going on. And why is that? Well, I think this is really helpful to understand is the reason that people are so tuned into the Fed is because the Fed influences the valuation of asset prices. And so if you're investing in stocks, and if you're investing in tech stocks in particular, or long-term bonds, or long-term assets like real estate in general, the Fed has such an impact over their long-term prices. Now, in the short term, you're going to see these fluctuations from day to day. You're going to see a bad quarter, a good quarter from a company. In the long term, you are going to see great companies, no matter what interest rates do, be fine. And they're going to take their balance sheets and they're going to de-lever and they're going to de-risk and they're still going to make money. Look at JP Morgan, had an unbelievable 5-6 years here and have run that business incredibly well. Jamie Dimon, he's a risk manager. And you've seen the same thing happen at Goldman Sachs. You've seen it happen at Home Depot and Sherwin-Williams and all these great American companies. But at the same time, in the short run, when the Fed messes around with the monetary supply and interest rates, it does have an impact on what we pay for asset values. So if you don't have assets, and the Fed is irresponsible like they were in 2019 and 2020, leading up into COVID, then you do not have any protection against rising cost of goods and services against inflation. In fact, when we were on the gold standard, we had no inflation. Inflation was like 2% over the course of 100 years. Well, then all of a sudden, you had Richard Nixon take us off the gold standard, and inflation skyrocketed. And it all started because FDR actually outlawed the private ownership of gold at one point. Then Richard Nixon continued it. And ever since we've been off the gold standard, inflation has skyrocketed. By the way, you don't learn this in econ. You don't learn it in 101. You don't learn it in 201 or even the upper level courses that I took. you have to figure this out for yourself. You have to go back to the Milton Friedman School of Thought and the University of Chicago economics, which say inflation is always a monetary phenomenon, which simply means that when you print dollars in the economy, you devalue each incremental dollar. And it's too many dollars chasing too few goods. It's as simple as that. If you think that you can just print your way out of a mess, just look at Japan. Japan has a 250% debt to GDP ratio. Now, have they completely fallen apart? I think this is where the bears have completely missed the boat in the U.S. economy. They've completely missed the run-up in U.S. stocks because they thought we were going to end up like Japan. But even the case study of Japan, yes, it's been slow growth, but it hasn't been an all-out collapse. You can still have a thriving economy. You can still grow your economy. You're just going to do it a lot more slowly than if you didn't have as much debt. So that's where we're at as the U.S. We're still about half of where the Japanese are as far as the debt to GDP ratio is concerned. Mainland China fudges the numbers. We know that. They just came out and said that they had 5.6% GDP growth. Really? You believe that? I don't, because I look at the luxury goods sales. I look at everything else. I look at real estate. I look at all the other problems they're having. And the story doesn't line up. If your people aren't doing well, your people aren't buying stuff, and you have a real estate crisis on your hands, how can you possibly try and convince us that your GDP is up 5.6%? It makes zero sense. You also have more millionaires leaving China than ever before, more billionaires leaving China than ever before. Same problem the UK has. Look at the UK. More millionaires and billionaires leaving the UK than ever before. Nobody wants to die in the UK. Great place to live, great place to hang out. You could work there, have a nice time, maybe go on a riverboat cruise in Europe and drink some tea and eat some crumpets. But then you figure out, if I die in the UK, I've got like $700,000 I can pass to my kids without any tax, and then everything else is taxed at 40 to 50% inheritance tax rates. You're like, why in the world would I die in the UK? It makes absolutely zero sense. Same thing in France. Same thing in a lot of places in the EU. And people are saying, I want to live in the place where there's the rule of law and personal property rights, which is the U.S., which is why you have all the smartest British, all the smartest Scottish, all the smartest French, and Germans, and Chinese, and Japanese. We're a melting pot of all the best and brightest minds in the world. Why? Because when you die here, at least for now, we've got $30 million we can pass down to your kids tax-free, and that's a huge difference. And so people want to be here. They want to innovate here. But it doesn't mean that we can't just run these massive deficits forever. We're going to have to figure it out. We're going to have to balance our budget, and I do think it matters. Now, the U.S. economy is not the same thing as the stock market, because U.S. multinational companies are selling multinationally. They're selling into all these places. So you can have a company like CrowdStrike. You can have a company like Amazon. You could have a company like Microsoft or Google or any number of companies. Even a company like Coca-Cola or Procter & Gamble, they derive a huge portion of their revenues overseas. Yes, the U.S. is going to affect them, of course, but the rest of the world also affects them, and it can be in a positive way. Even if the U.S. is starting to have higher debt to GDP burdens, you can still see these companies do really well. And so why is it that you have to decouple the GDP of the country and the debt and everything else from the actual stocks? Because companies are actually more powerful, in my estimation today, than most politicians are. And actually, companies have sometimes higher GDPs. If you want to think of it that way, they have higher market caps than most countries' GDPs would be. They are literally more powerful than a lot of companies. Look at NVIDIA here, just crossed over a $4 trillion market cap. That's bigger than the GDP of most countries. Okay, so you just have to remember that companies are different than countries and GDPs and debt and all the rest of it. And so what we want to do is look at these companies very specifically. Now, in the short term, as Powell does or does not raise interest rates, I think you're going to see the valuation for companies start to continue to go up, because there's going to be this expectation that next year there is going to be a change in the Fed seat. And that's why you're starting to see stocks recover. Remember, we went down 20% with tariffs. We said just stay on your plan, and not trying to brag here, not trying to take too much credit, but aren't you glad you listened to us? Aren't you glad you came back to the show every week? I told you, don't panic, don't sell. Thank goodness you listened. Thank goodness you didn't get off back then, because the S&P is now at a brand new record all-time high. And by the way, I still haven't gotten a single call from one of these Wall Street pundits that cut their forecast when the S&P was at its absolute low. A lot of these guys cut from 6,300, 6,500 down to 5,000, 5,200. That was the actual buying signal. That was the time when you should have bought stocks. And here we are today at 6,300 on the S&P. Now, we obviously want to be humble, and I'm joking when I say all this, but we want to be humble and realize that we can have a correction at any time. And I think we are due for a correction at some point later this year. But at the same time, we said 6,700 for the S&P for 2025. And have we wavered once? No, we haven't. We have not taken you off your plan. Now, are we going to hit it exactly? Who knows? But I think directionally speaking, that is the way the S&P is headed over the next 12 to 18 months. And by the way, if you take the earnings estimates on the S&P for 2026 and then you go into 2027 even, you're looking at about 7,200 points fair value for the S&P, and that's without a ton of rate movement. So all that to say, will Trump fire Powell here? I doubt it. I don't think he's going to do it. I think he's going to ride out the term. Should he fire him? I'd say overall Powell gets a C, maybe a C+. But the reality is these guys were so late to the game. And Yellen, she doesn't get tons and tons of blame, but she ran a very loose Fed. She should have had interest rates a little bit higher when Obama was president. She didn't. And then Powell came in with basically no ammunition, and he cut rates to zero. You could say that was the right move. You could say that was the right thing to do right at the beginning of COVID. But then, again, I go back to Milton Friedman. I say when you go and print 40% more dollars in the economy, at some point you got to raise rates up from zero. They kept calling inflation transitory all of 2020, all of 2021, saying the supply chain shocks were just that. They were supply chain shocks, that you weren't actually going to see this permanent inflation that we've seen. And they were wrong. I mean, they were massively, massively wrong. They should have been at least 2-3% interest rates during the summer of 2021. And then we could have avoided that massive, massive pullback in 2022. But all that to say, central planning in general, I think if we're going to learn one lesson from all of this, central planning is an absolute disaster. You cannot rely on one or two people in the government to run the economy. It just doesn't work like that. And so there's been a lot of calls to abolish the Fed. Probably not going to happen, but I sympathize with the DeFi people. I sympathize with the Bitcoin guys, and I don't own any Bitcoin, just full disclosure, but I sympathize with all these people who say this is absolutely ridiculous. Fiat currency is just a joke. How can you possibly tell me that my 100,000 is going to be worth 100,000 10 years from today? It's not. And so the implication for investors is you've got to be in assets. And I said this at the beginning of the show. If you had assets the past 3, 4, 5 years now, you've been okay. Yes, your costs have gone up. Yes, your bills are up. Yes, your new car costs way more than it did in 2019. But at the same time, all your stocks are up 30, 40, 50. Some of them are up 100% in a lot of cases. And so you've been okay. Your house is up. So if you have assets, you're going to be fine. That's why I say have some rainy day money in your plan. But at the same time, you've got to have assets that are going to beat inflation over the long run. So that's what I would encourage you to do. Stay in your plan, stay in equity, stay in great companies. In the long run, valuations will matter. If you pay 500-600 times earnings for a stock, doesn't matter how great the story is today, eventually that company's going to have to keep up with its earnings per share multiple, its PE ratio. And if it can't do that, you're going to pay the price long term. So a value stock, a company trading at 15, 16 times earnings that does a 2% buyback, 3% dividend yield, it's not a bad company. It might be a little bit boring, not the most exciting thing. It'd be something that we would buy for clients. But over the long run, those are the companies that power the portfolio forward and don't put you at substantial risk. Before we go, 2 big events coming up. Producer, if you don't mind throwing them up on the screen there, we've got the live episode 200 live taping. You can't miss this thing at Francesca's Restaurant, downtown Naperville. Don't forget to register. We're about 60-70% full there. Very small room, very fun venue, very cool place. And we have a very special gift to thank you if you've been watching the show since the beginning. By the way, if you're not subscribed, go on YouTube, Apple, and Spotify. Subscribe to the show. We're on our way to 1,000 subscribers here on YouTube, and we need your help to get there. So thank you so much for being on here. And then the second big event that I want to show you before we go is 2026 Investor Day, October 16th and 17th, downtown, well, not downtown, but at Oak Brook Mall at Gibson's. And we're going to be doing our big investment conference that we always do. You can't miss this thing. We've already got, I think, about 90 people almost signed up. So we just have a few spots left. You got to get on this thing. It's about 70% full. It's going to be full very, very soon. If you've been thinking about coming up for Investor Day in the past and you just haven't been able to pull it off yet, come into town for this thing. You won't regret it. You're going to have a great time. You're going to meet most of our team will be there. You'll be able to hear from our investment committee, hear from some guest speakers that we like to listen to. Come out to Investor Day, October 16th and 17th, and we'll see you next time for episode 195.